Welcome everyone. Brandt, Endeavor Wealth Management, investment advisor here. We are live. I'm here with my partner and colleague, portfolio manager, Grant White, and today we are talking about retirement. Specifically, is your retirement protected? Before we get into it, Grant, I wanted to just throw out a couple statistics from a recent poll by a large Canadian financial institution here. In the poll, what they found was 32% of Canadians between the ages of 45 and 64 don't have anything saved for retirement. Another 53% of the respondents that were polled said they don't actually know whether or not they're saving enough for retirement. And another troublesome finding was that with the poll, the average savings level of a person approaching retirement was $184,000, which we know from our expertise doesn't get you very far.
Right.
So with that, Grant, are you concerned about Canadians' retirements?
Yeah, I mean, I think that's a good question, and I'd have to say, I mean, for a lot of people, yeah. I mean, those stats don't lie. I think that's very telling, and the reality is there's a lot of things that have changed for people in retirement. People are living longer. People are living healthier longer, so they're spending more money in retirement, and that has never been planned for before. There's less and less defined benefit pension plans out there. Every year, there's companies that are switching their defined benefit pension plans to other types of pension plans, or like defined contributions, which may not be as safe or as long lasting. People are living longer and spending more money on healthcare. I think one of the things that the pandemic has really brought forward is in-home care versus going into a care home, and that costs money, and not a lot of people are planning for that. So all of these things are adding up to, concerns about retirement, because I think that people haven't planned necessarily appropriately for it. And a lot of it is also, they're still planning traditionally for their retirements. The same things that they've been doing, or that planners have been doing, or advisors have been doing for decades and decades, they're still thinking the exact same way, when the reality is we think things have changed. And this is really evident when it comes to how people are investing their money today. Where we're talking about 60-40 portfolio being the traditional retirement portfolio. But we just think that might not be what's needed going forward. I mean, I don't know, why do you think people have such blind faith when it comes to a 60-40 portfolio going forward?
I think it has to do with exactly how it's performed. And I know we have a chart here that we can show. And if we look if we go back 92 years and we look at the returns of the S&P 500, which is an index that tracks and measures the 500 largest U.S. companies in the world, all stocks. If we look at what that's returned investors, it's done over those 92 years approximately 10.1%. So
right.
Really good returns. A 60-40 portfolio, however, did this and achieved an 8.6% return. So not bad as well, and
pretty respectable. Yeah.
Pretty respectable. If you're viewing and listening here, you may have the question, well, why would I take the 8.6 over the 10.1? That really comes down to the volatility. If you looked at the S&P 500 portfolio, there would have been a lot of peaks and valleys to that, lots of volatility. When we look at the 60-40 portfolio, it achieved that 8.6% with 40% less volatility in it. So although volatility, we talk a lot about the opportunities that come from volatility, the ability to purchase assets at depressed prices, the majority of retail investors out there are emotional, and we have to factor in whether or not we can show you that 10.1% and what you would have achieved over those 92 years, but that's different. It's different if you aren't willing to stay the course. So if a portfolio comes with a tremendous amount of volatility, there's risk in that you're not actually going to stay disciplined and you're not achieving that return that we're showing in the index. Whereas the 60-40 portfolio, when we look at that, the 40% reduction in volatility, well, you have a lot higher likelihood that your investor and your client is going to stay the course when they are able to sleep at night, because the portfolio is not bouncing around as much as the all equity. So before we kind of get into the challenges retirees are likely going to have from that 60 portfolio moving forward, it's worthwhile to discuss why the 60-40 portfolio was able to do its job over those 91 years. And some of you may be aware of this, but we do have lots of discussions with incoming clients about difference between stocks and bonds. Well, stocks have really been a portfolio's growth engine. They come with higher expected returns, but as we mentioned, more volatility. Bonds, however, have been those safe investments, or viewed as those safe investments. A lot less fluctuations, however, you're getting a lot less return as well. And historically, these two asset classes have historically had a negative correlation, meaning when one moves in one direction, the other moves in the opposite direction. So
that's the idea, right? Yeah.
When stocks did poorly, bonds did well, and vice versa, and hence that that 8.6% return with that 40% less volatility from the 60-40 portfolio. But today's environment is different. Interest rates are at all-time lows, making it extremely challenging for someone who's either retired or approaching retirement. So, Grant, maybe you can talk a little bit about interest rates and where we think they might be going.
Yeah, and I think that's such an important conversation that needs to be happening right now, and this is why we talk about the traditional 60% stock, 40% bond portfolio is in our minds dead, because the interest rate environment is really different. I mean, we're at all-time historical lows again in interest rates. I mean, like, we were just there. They started climbing up again, and they're back to all-time lows. And that creates a really interesting environment for what would have been like 40% of somebody's portfolio. Because not only are those bonds that you're buying today paying you much less, I mean, the fact is that you can't really rely on the interest rates that are being generated by a lot of like traditional bonds, because they just don't get you the rates of return that you need to be successful, or in most cases, what people need to be successful. So not only are they not getting you what you needed to get and not getting you what you would have gotten traditionally, but they also create a lot of risk, and we call this interest rate risk, because if interest rates start to climb, these bonds that you're buying today at lower interest rates go down in value. And we have a chart actually that shows that, and you can see on this chart the correlation between the two. So as interest rates are climbing up, you can see that on the inverse side, the bond prices do the exact opposite. So the bond prices here are listed in the orange line, I believe, whereas the blue line is interest rates. And so you can see that they're moving in the exact opposite direction. Now, where this becomes really a problem is especially if we start to see things like rising inflation. And the number one way to fight inflation through the whether it's the Federal Reserve or the Bank of Canada is to increase interest rates. So if you're in the mindset that the government has recently put a lot of money into the economy, like I am, well, it's not a mindset, they have. This is the reality of where we are. There's been a lot of money printed. There's been a lot of money pumped into economies around the world, and that has the potential to add up to inflation at some point. And if the inflation does start to show up, we're going to for sure see interest rates start to climb. Now, a lot of people are like, what does that actually mean? Well, we've done some math more recently on this, and what we've looked at is that if there is about a 2%, I'm not going to get into too technical on this, but if there's about a 2% in interest rates, that could be approximately an 18% negative towards some traditional government bonds.
Yeah, I think we were looking at a 10-year Government of Canada bond that's paying you 0.5%.
Right. So a 10-year Government of Canada bond, normally a rock-solid safe investment in clients' portfolios, could potentially be down 18% with just a 2% increase in interest rates. Now, 2% interest rate increase, how likely is that to happen? Well, if you look at it just a couple years ago, I think we were looking at October of 2018, interest rates were sitting at about 2.6%. So just 2 years ago, interest rates were at a level where if that went back to that level today, a lot of people would be facing negative 18% in their bond positions.
Which is considered often their safe investments. So.
Yeah, exactly. So ultimately the question becomes, what should retirees do?
Well, if you're retired or approaching retirement, you may ultimately need to work a little longer, which often isn't the number one or favorite solution out there when we're working with clients. As well, you may need to live off less. Again, not fun to say, hey, you actually can't spend X amount of dollars per month. You need to spend less than that. Even worse, you may be forced to live off of government pensions if you outlive your savings. And the government pensions do pay a decent amount when it's a supplementary amount. I don't think you want to be living off of your government pensions. And then even worse, you could be forced back into the workforce either on a part-time or a full-time basis. Not something that you want to see when you're...
None of which are really great options.
None of them are good options. So what can you do about that? Well, maybe lower your expectations. You may have an idea of how much you want to spend, and like I said, you may need to be spending less than that. But a lot of what we're doing today in helping individuals navigate this interest rate and potentially inflationary environment is exploring alternative asset classes. So things like market neutral funds have become very popular to again shift some of this inflationary interest rate risk into some other asset classes. Things like precious metal, gold and silver. Yeah. You wonder why we've seen gold prices going up as of recently. Infrastructure investments, so things like toll roads, bridges, power plants, things that kind of clip and collect an income regardless of the environment. And then lastly, and often the one that isn't people forget to think about or don't pay enough attention to, is proper financial planning.
Right.
So Grant, maybe you can talk about how, I know we talk a lot about returns here, but is it just about returns in retirement planning, or should people be doing something else?
No, yeah, I think if you're solely focused on just trying to generate higher returns, I think you're missing it. And frankly, I often call myself the enabler advisor, because like some of the things you mentioned about what can people do, like lowering their lifestyle, things like that. That's like the last thing anybody wants to go through. I'm much more of an advocate of, like, if we do proper planning and we think ahead, we can avoid all of those really difficult decisions, and in fact, we can go on living the lifestyle that you ultimately want to live, and maybe even exceed that lifestyle. So proper planning becomes really, really important in all of this. And one of the examples I'd give of that, and we have a pie chart to show you here, is what I think is a simple strategy. We call it the cash wedge strategy. And really what this is no matter what happens in the market, what we try to do with this strategy is make sure that where your income is coming from is going to be protected. And this is particularly important for people that are getting close to retirement, certainly the ones that are in retirement already. But even as you're getting close to like a midterm kind of a goal, this might be a strategy that you might want to implement. And the idea behind it is that we're going to actually segregate out about 2-3 years, maybe more years of your income that you're planning to live on for your lifestyle. And we're going to take that away and put it into either ultra safe investments, ultra low volatility investments, or maybe even guaranteed investments. With the idea behind it that the rest of the portfolio, which you can see in, we've got blue, would be your equities, the darker blue, you got orange, you've got your traditional bonds, you've got real estate and gold, alternative assets like you were just mentioning, that would be in gray. Though the rest of the portfolio can do what it's going to do. It's going to fluctuate. We're going to get pandemics. We're going to get financial crises. And the portfolio is going to balance. It's going to be consistent. But there is going to be times when it's not always positive in value, or certain aspects of it. But that doesn't matter if you employ this strategy, because where your income is actually coming from is all protected.
We always say to the clients when we're talking about this strategy, if we're going through a market correction or crash and whatnot, if you didn't open your statements and you had the cash wedge in place, you wouldn't know that anything was going on, because your income was protected and was still coming in.
It's so true. I mean, this year is a perfect year to look at that. I mean, if you looked at a lot of our balance clients, for the most part, they're positive on the year. Had they not looked at their statements from January to now, they would be thinking nothing really happened. We're having a great year, but little did they know that there was a pandemic that's going on in the middle of it, right? So this type of strategy ultimately protects you from that, because when it comes to retirement income, and we've got some numbers on this, timing does matter. And we're not market timers. Like, this is the thing. When it comes to investments, we don't try to predict the market. We don't have the crystal ball. But when it comes to income and drawing money out of your portfolio, the timing does matter on the returns. And using a strategy like this can take that timing question ultimately out of it. And so what we're showing you here is we basically did 3 different scenarios, 3 different plans, all of which the average portfolio return was 7% per year. And we took it out over 10 years. Okay, so you can see in the top line there, 7% is a guaranteed 7% in this case scenario. Difficult to get a guaranteed 7% anywhere today, but that was the scenario. Guaranteed 7%, you got it like clockwork. And so you started with an investment portfolio of $200,000, and you live pretty modestly. You're only drawing $15,000 out a year on this portfolio. By the end of the 10-year plan, you are drawing down your capital, because you're drawing out a little bit more than the 7% you're earning, and you end up with $186,000 approximately by the end of 10 years. Okay, and that's with 7%. The second return, or the second portfolio, what we did was we looked at it, and these are pretty realistic numbers. But we got high positive numbers in the early years, and then they had some negative years, mostly towards the end of the 10-year period of time. And what you can see is that when you get high positive numbers in the early years, you can see the portfolio goes from 221,000, 239, 236, and so on and so forth. So by the end of it, after 10 years, even though you still average 7% per year, you now had $207,000 versus the 186 from the first portfolio. Mm-hmm. What we did on the third portfolio is we just reversed those numbers. Okay, so you got negative numbers early on and positive years towards the end. And the big difference is when you get negatives early on, this is where timing matters. Mm-hmm. Because by the end of 10 years, now you're down to $133,000. So that's essentially it's an erosion of about $53,000 as compared to the first portfolio.
All from pulling income from depressed assets.
Right. So this is why we say planning matters so much. It's not just about returns, because we could have averaged 7% per year and the portfolio has done what we'd hoped it to do, but without these planning strategies in place, you still end up down at $133,000. And I have significant concerns about whether or not your portfolio is going to sustain, your $15,000 a year. If you retired at 55, you're only 65. What are you going to do for the remaining 30 years of your life? Plus, right?
Yeah, it's so important.
So anyway, that's why we say, yes, do we have concerns about retirement and people who are retired? Yes, we do. But there is things that you can do, and that's really the key to all of this. So I think with that, we're going to close things off.
Yeah, absolutely. Please, check us out at www.endeavorwealth.ca. You can, like, subscribe. We have YouTube, Facebook, LinkedIn. So more to come. Excited to share different retirement planning strategies, investment-related materials, and so with that, thank you again for tuning in.